Hi, good morning. This is Matt Sainholtz from Tobias Financial Advisors. We will be waiting another minute or two for a few more of our attendees to join, so please hold tight and we'll be with you in a moment. Hi, good morning, everybody. This is Matt Sainholtz. I am President and Chief Investment Officer here at Tobias Financial Advisors. Thank you for joining us for our third quarter update and market review. And today we'll be reviewing the markets and the portfolios and some general economic concepts. And we also have a guest, which I'll be introducing in a few moments, Kevin Flanagan. He's the head of fixed income from WisdomTree. Will be giving his thoughts on the interest rate world and the bond markets. Before or as we get started, we need to just kind of go over that this is a general presentation. Of course, your specific goals and unique circumstances are unique to you, and so this is meant to be informational. If you do have specific questions about any topics that we're covering here today, please reach out to your advisor or us here at Tobias Financial Advisors, and we'd be happy to go even more in depth about the concepts discussed here today and how this may affect you personally and your family to help you achieve your financial goals. Another point of housekeeping today is that you have a box there under the there's a box there under your under the polls and questions that should be able to answer put in a question. If you have a question come through, we will try to address those at the end of our presentation as best as we can, and please feel free to use that, and we will address that as we can. So just a little bit about who we are before we get started. Tobias Financial Advisors, we were founded in 1980, so we are knocking on the doorsteps of our 40-year anniversary. We manage $400 million for our client base, which mostly consists of private families and personal individuals, as well as some businesses and 401k type retirement plans. We believe in education. We are a team of certified financial planners, chartered financial analysts, and certified public accountants. So we have a breadth of experience to help you achieve your goals. So as I mentioned today, we have Kevin Flanagan. Kevin, are you with us?
I am here.
Okay, welcome. Kevin is the head of the fixed income strategy at WisdomTree Investments. He serves in his role, he contributes to the asset allocation team. He writes fixed income related content and travels with the sales team, conducting client-facing meetings and providing expertise on WisdomTree's existing and future bond ETFs. In addition, Kevin works closely with the fixed income team. Prior to joining WisdomTree, Kevin spent 30 years at Morgan Stanley, where he was a managing director. He was responsible for tactical and strategic recommendations, creating asset allocation models for fixed income securities. He was a contributor to the Morgan Stanley Wealth Management Investment Committee and was an author of the Morgan Stanley Wealth Management Monthly and Weekly Fixed Income publications. He has tremendous experience. He has his MBA from Pace University and a BS in finance from Fairfield University as well. So we're happy to have him today. Before I get Kevin's thoughts, I would just like to take a few minutes to remind everyone of our general overall philosophy and a little bit of our market summary from the third quarter. So, if you've talked to any of our advisors, we definitely believe in investing for the future, investing for the long term, and that we are here to preserve and preserve your wealth and grow it. And one of the things that we think about when we're developing our investment plans is developing that plan and sticking to the regimen and how we develop our portfolios. So we want to structure the portfolios at the highest level between fixed income, which we're going to talk a lot today. Fixed income and bonds are one and the same. We'll be using those terms interchangeably today. And we want to structure the portfolios between bonds and stock funds and to develop long-term approach. We want to diversify broadly, and we really want to focus on what we can control. We can control our expenses in the portfolio. We can control the tax effects of some of the moves that we make within the portfolio by shifting between short-term and long-term gains. Markets are volatile. Markets are going to do what they're going to do for the most part, and we want to tilt where we can to achieve better returns. But we're in it for the long run, and we're not going to be doing every tweet or every news line. We're not going to be making portfolio adjustments just to react to the market headlines. As I mentioned, today's agenda, we will be doing a pretty brief third quarter market summary review, and then we'll be diving into our interview with Kevin Flanagan to give us kind of the insight on what the Fed is thinking. And beyond that, we'll have some summary points and where we might be able to invest, where is there opportunity given the market structure and the economics today. And as I mentioned, please feel free to put any questions into your screen today on today's webinar. So what happened in the third quarter? The third quarter in the stock markets, the U.S. stock market was up slightly at 1%, and international developed markets were the reverse of that. They were down about 1%, and emerging markets were down about 4%. That may not be surprising if you pick up your newspaper or read on the internet about the conflicts with China, the trade war, trade tariffs around the globe that we are experiencing, and trying to understand how this is going to affect the global economy. On the bond side or the fixed income side, when rates go down, the bond returns go up, and so we saw a rate cut in the U.S. So bonds were up about 2% in the last quarter around the globe, and we'll see more of that. So world stock market performance in the last 12 months, if you can think back to this time 1 year ago, we saw some volatility, some downward volatility. We experienced from September 30th to Christmas Eve, December 24th, pretty close to a 20% drop in the markets. And since then, year to date, we've pretty much recovered from over the 12 months from last September 30th to this September 30th. The U.S. market return, as defined by the S&P 500, is up about 4% over the last year. And so, we've seen a good recovery even in the face of some of these headlines about recession and Brexit and trade tariffs and on all these major events that are going to shape our world, but haven't quite figured out, so we haven't seen the solution yet to some of these issues that we always hear about in the financial news. So what clients are asking. What is the economic outlook over the next 12 months? There is a lot of talks and angst about if we're going to enter a recession, what's the growth going to be look like? So, Kevin, what do you see as your baseline U.S. economic outlook for the next 12 months?
Yeah, we have not been in the recession camp. We certainly acknowledge some of the challenges out there and agree with the Fed on this front. Obviously, trade uncertainty, you alluded to it before. We may have a phase one trade agreement between U.S. and China. We'll see. There's been a lot of false starts. Just to give people a little bit of perspective, I think it's around mid-November. There is an APEC summit in South America, and the hope was that is where they were going to ink that agreement and then move on to the next phases. I know Larry Kudlow was on the TVs yesterday talking about potential progress could take December tariff rate increases off the table. So it looks like for now, some of the tensions have cooled off a little bit, but as we've seen throughout this fits and starts, you never know when we're going to go back again, potentially into another hostile-like situation. And certainly global growth throughout the developed world leaves a lot to be desired. Europe, you're looking at countries like Germany, they've already hit 1/4 of negative GDP. Italy's on the brink as well. So the Eurozone not doing all that well economically. China is seeing the bite of these tariffs and is seeing some visible slowdown also. But there's positive news. On the positive news, and these forces, I think, continue to offset what we've seen on the negative side, and we're expecting to continue to see supporting going forward. And it all starts with the labor markets. We're talking about an unemployment rate at its lowest level since 1969. You're looking at some good employment growth in the civilian numbers. I know everyone focuses on non-farm payrolls. Promise I won't go down the rabbit hole, but there's another measure called civilian employment that's been moving very, very robustly of late. And typically that number and non-farm payrolls, which everyone is used to, tends to come together. So some of the numbers that have come in a bit less than expected of late may actually be revised up, and we saw that in the last month's report also. And jobless claims, you can't forget jobless claims. It's one of the leading indicators, and if you look at the charts of where we are at 210,000, it certainly does not point towards any type of recession in the next 6 or 12 months unless we start to see a dramatic change there. And all this has helped and given rise to a pretty solid consumer outlook, so consumer spending really offsetting the effects of manufacturing drag and investment. So the way that I look at it is that the New York Fed probability indicator for the next 12 months for a recession is basically 2/3 no recession, 1/3 chance of a recession. I would tend to agree with that.
Okay, yeah, very good. I mean, some of the jobless claims you assume have to be affected by the auto workers strike, and so those numbers are probably going to be coming out of the data soon if there's a solution there as well. So thank you for that. What we also we're hearing about is, we're at really low historically level of interest rates, and what you mentioned right there is 2/3 probably not recession, 1/3 recession. So in the face of that, what do you think the Fed, our U.S. Fed, is going to do about rates at the October meeting throughout the end of the year and into next? If you could talk about what the market's showing and what your thoughts might be.
Yeah, I mean, the Treasury market certainly has priced in a lot of good news. It's Halloween, us bond market ghouls. Bad economic news is good news for us bond market guys. So it's been that way for a while. However, this latest sell-off that we've seen with rates moving a bit higher from where we were, actually more than a bit higher. If you look at a 10-year Treasury note, it's now up over 30, 35 basis points from its most recent low. So you have seen a little bit of a correction, and I think some of that has to do with the fact that the economic numbers are hanging in there, that you have seen a little bit of a thawing in the trade aspect. So that goes into what the Fed is going to be looking at. I tell you, I've been doing this for more than 30 years, and I've never quite seen, at least in recent time anyway, a Fed that's fractured, this divided. And I think the blue dots, for those of you guys who aren't familiar, the Fed's own projections of where they see Fed funds this year and next year, they really highlighted that at the September meeting. There were 5 Fed members that actually anticipated a Fed rate hike this year. It's quite fascinating. So you have that camp. You have a camp like James Bullard, the St. Louis president, who would like to see 50 basis point rate cuts occurring at a meeting, and then that in between. So the way that I look at it, the historical precedent doesn't always jive with present day Fed situations, but I thought this was interesting. If you go back to the last time the Fed was in insurance mode, which is I think what everyone is kind of referring to this at this point in time, even Fed Chairman Powell is calling it a mid-cycle policy adjustment. So not on the verge of continuous easing or continuous rate cuts. So in the late 90s, the last time they were doing this kind of policy behavior, they cut rates 3 consecutive meetings in a row, a quarter point each, so 75 basis points, and then they moved to the sideline, and they went to the sidelines for quite a long time. So if you wanted to sort of extrapolate 20 years ago to where we are now, I think it's quite interesting because they've already done 2 25 rate cuts in the last 2 consecutive meetings, so that would open the door for October. But what the Fed doesn't want to do is present this fractured or divided outlook to the general public. So this one may be a little bit more difficult. If I were to put my chip on the table, do I think the Fed's going to cut rates one more time this year, October or December? I'd probably say yes, and if they're going to do it, they should do it now. Don't wait till December. But they're going to need, I think, to show a little bit of a change in their messaging to the markets. And what I mean by that is in the recent FOMC minutes we got, there were a variety of Fed officials that said, hey, the markets are priced for something we're probably not going to deliver. And what that market pricing is for 3 rate cuts between now and the end of next year. So what the Fed may do, cut rates in October and then kind of message to the markets a little bit that, hey, maybe we are going to take a little bit of a step back here, see what these 75 basis points and cuts has done on the economic data, and we will act to sustain the recovery if we need it, using that traditional classic Fed language. So I think that's the more likely scenario. I think that would be viewed as the first 2 were talked about being hawkish rate cuts. This would be viewed as a definitive hawkish rate cut. And I wouldn't be surprised if you actually saw Treasury yields move a little bit higher from where they are now, if in fact that's what we get. One last thought is that I wanted to bring this to everyone's attention, is that the Fed about a week ago announced they're going to be buying $60 billion in Treasury bills on a monthly basis. So in theory, or by definition, when the Fed is buying and adding to their balance sheet, that is known as quantitative ease. But I think the Fed did a very good job in their messaging saying that this was not your father's QE. So this wasn't QE 1, 2, or 3 to boost the economy or prevent a recession. It was to provide sufficient reserves to the banking system, something that the Fed does usually on a temporary daily basis using repo operations, but it had gotten to the point they needed to add more oomph. They needed to add more liquidity to the system in order to prevent another September 16th, which all of you may recall we had a spike in funding rates on that day. So the Fed buying T-bills was another good way to message it, because this way you're not manipulating interest rates, right? If they were going to be buying 5, 10, or 30-year treasuries, then you're kind of scratching your head going, wait a minute, maybe this is something a little bit different. So far, so good. So call this QE with an asterisk, and it has more to do with funding markets and really less to do with the economic outlook.
Well, thanks for that, Kevin. And it sounds like we've had the 2 rate cuts already in 2019. The Fed is on the pause by providing liquidity where it sees fit. And that's maybe why we're not seeing so much volatility as we traditionally do in October in the stock markets. The stock markets traditionally, October is a scary month. And I think it's having to do with the Fed being there and being supportive and accommodative to probably kind of keep economic growth chugging along. So what we have up on our presentation here, the yield curve, and we have the blue line. This is as of September 30th, so just a couple weeks ago. The blue line is the interest rate curve, and on the bottom is the length of time of the different bond issues out there. So at a 3 month, as of September 30th, 3 months cash T-bills were paying just south of 2%, where you could put your money away for 10 years and only get 1.68%. And when that phenomena happens, where you actually are able to get more return by keeping your money in shorter term instruments, that's called an inverted yield curve, because the curve is sloping downward. And typically a lot of economists will say when we get an inverted yield curve, that would signal recession. And people will get a lot of nervousness, energy around that, and think that that is a very sustainable indicator. So what Kevin was alluding to earlier was that this chart shows the 10-year at 1.68% just a couple weeks ago, and being inverted, being lower than the 3 month T-bill. That has recently, let's call it, uninverted, and now the 10-year is above the 3 month T-bill. So Kevin, does that signal anything to you? Does that mean maybe the recession scare might have moved on?
Great questions. Shameless plug. I'm going to have a blog coming out on this tomorrow.
Okay.
It's fascinating the fanfare we got when the 3 month 10-year. I'm a 2-year 10-year guy, but I don't want to muddy the waters, because the focus has been on the 3 month 10-year curve. And back in May, when it went inverted, remember everybody, essentially you turned on any of the financial market channels, and you were inundated with the yield curve has been inverted, we're going into a recession. And what you just mentioned, this uninversion or re-steepening, has really received scant attention in the media. And I'm not making this a thing against the media. I just thought it interesting that it is perhaps an interesting development. How important, though, is another question. Certainly it makes the outlook from a yield curve indicator perspective perhaps less ominous, because you now are in positive territory and you have seen a dramatic shift. So just to give you a sense, I think it was August 27th, the 3 month 10-year, the peak inversion was a little over 50 basis points. And if you look at where we are now with the 3 month and 10-year, it's about plus 15 basis points. And it's the resulting steepening has occurred at both ends. So take the 10-year. As I mentioned earlier, the 10-year went from in the low 140s to now we're a little bit below 180. So that's part of the equation. We already talked about that. Some of the little changing outlook, perhaps less negative news on the economy and on the trade front presenting itself there at the back end of the curve. The front end, two things working. First one being what I just mentioned. The Fed's going to be buying $60 billion in Treasury bills over the next, say, 4, 5, 6 months at a minimum. So certainly that comes into the equation as well. That's a rather large buyer coming in to the bill market. The other part is that the T-bill arena has now priced in that rate cut for October. So much like we see quite often on the flip side of the coin when the Fed's raising rates, the market doesn't wait for the Fed to actually make a move. It begins to price in ahead of time. So what you're seeing right now with a 3 month T-bill at 1.63% is right in the middle of what would be the new Fed funds target if they cut rates in October, and that would be 150 to 175. So you've had like a 30 basis point move in the front end on the downside, 35 or so on the other side on the back end. Thus, you get that re-steepening. Now, history would tell us that that's good news, that perhaps maybe we avoided the worst. But, I am a student of history. We were inverted for about 5 months at a 50 basis point magnitude. So that's that 1/3 that I continue to look at for recession. That's why I'm not ready to say, oh, no, we've eliminated the odds of a recession, because we have to wait. This has a lagging kind of effect or indicator for the market. The one interesting thing, as I mentioned first up, the New York Fed, that New York Fed indicator is really the 3-month 10-year Treasury yield curve. So that's probably going to get adjusted when we get the next number, and will probably be less than 1/3 going forward. So I think it's a good sign. It's less ominous for an indicator going forward, but I'm not ready to necessarily flash we're definitely all clear at this stage of the game.
Very good. I appreciate that. So sounds like could be moving in the right direction in your mind, but maybe not out of the woods yet. So what are you watching other than the New York Fed, as you mentioned, or what are you seeing or watching that the bond market may not necessarily be taking into account?
Well, one thing we didn't mention was developments overseas. And, just real quickly, I was over in Europe a couple of weeks ago, and I found it fascinating talking to clients over there and listening to their vantage point. The bond markets on the developed world are very interconnected right now. Now, I'm not saying that this would have a primary influence on treasuries, but it will have maybe a secondary type of influence on where yields could go. So just something like looking ahead. What should we be looking at? Well, one of these, could we get fiscal stimulus from Germany? Now, there's one camp that suggests never happen. Germans don't want to bail out Southern Europe. They wouldn't do it. There was another camp that was very adamant, saying it's going to happen, and it's going to happen sooner rather than later. And it's not going to be shovel-ready kind of projects. It will be real. And the thought process being that if you were to get a negative quarter of GDP in Germany, that's a textbook recession, and it may come to the point where it's like, hey, I know this may help Southern Europe, but we got to help ourselves. We need to do something to get us out of this downturn. And keep in mind, 2 new leadership individuals will be occurring in Europe in perhaps the 2 most important parts. One of it in Germany, Angela Merkel will be giving way to a new leader in that party, and you have Christine Lagarde coming in for the ECB beginning November 1st. And the thought process is that this could already be in the works. And Lagarde is less of a central banker and more of a politician. So, you could have a little bit of deal making occurring. That was the mindset. So I just thought I'd throw that out there. One other thing, because I like to take the other side of the trade, and that's what this is doing. Inflation. Core CPI is now 2.4%, one of the highest readings we've had, I think, in about 10 years or so. So inflation is muted. We're not worried about inflation, but somehow stealth-like, you've actually begun to see a little bit of an increase in core inflation. Just a few things to keep an eye on. Once again, I'm not losing sleep over any of this, but, always thinking a little bit outside the box.
Thanks, Kevin. That kind of leads into where do we see what our clients are asking, where do we see opportunities to invest? And that was a great anecdote about your travels to Europe, because that is one of the areas that we've been recommending for the past couple of years now. What you're looking at now is the S&P 500 being the gray bar. You can see that it has tremendously outpaced the purple line, which the purple line is all the other countries in the world except the United States over the last 8 or 10 years. And what's really important here is when we use a couple ratios when we're thinking about valuations, is the market on sale or not, or is it too pricey? When you're looking at, when you're comparing to the U.S. versus the rest of the world, the PE ratio, a price to earnings ratio, which kind of gives an indicator of value. The United States is a 16.8 price to earnings ratio, where the rest of the world is at 13.3. And what that indicates is that there might be better value abroad. In addition to that, we're having a whole conversation here about 10-year fixed income and 10-year bonds only paying somewhere in the neighborhood of 2%. So where can you put your money to get some extra yield and some return? Well, the S&P 500 in the U.S. pays dividends of about 2%, and you compare that to the rest of the world, and you can get a dividend of about 3.5% across the globe when we're investing in our diversified portfolios. So, another thing to consider as we are thinking about where we want to kind of position ourselves and how we want to position ourselves and the equity side of things, we are still considering the effects of the new ECB president, Lagarde, across the pond. And again, just the typical valuations that we're seeing. It makes us want to stand put and stay strong on our international allocations, even though over the last 10 years, U.S. has been a leader. Again, this is really okay. Well, we've heard a lot today about international versus U.S. and just a general philosophy of fixed income bonds versus your stock market exposures. This is a chart that goes over different time periods. This goes back to 1988. You can see, obviously, 100% stocks over the past 30, 40 years has been, well beyond just investing in the brown line at the bottom, which is being very conservative. What I would say is it's interesting to see that over long periods of time, this is just really telling the story of diversification, not putting all your eggs in one basket, and that that's where we work as your advisor, to work with you to see how much do we need to put our pedal on the gas to help deliver returns, and how much volatility we're willing to take. But it's just interesting to me that over the 5 and 10-year periods for a 75% equity, 25% fixed income type of portfolio, you're looking at 7% returns over the 10-year period. But again, back to that 1-year period, going back a year ago, maybe you might feel your portfolio hasn't gone that far, or what's happening is the portfolio is kind of stuck. It's not going anywhere. You just got to stick to the plan and stay committed to these international markets and these portfolios that are going to zig and zag over time, but over the long run, we do expect positive returns well above inflation. So the year-end outlook and summary, these trade tariffs, Kevin mentioned a bit about hopefully having a phase 1 resolution in place. That continues to drag on corporate markets. So as you can imagine, these big companies in the world today are S&P 500 type companies, are global. They have to figure out, are we allowed to use Chinese semiconductors or not, or should we have to source them from another country? It adds a lot of uncertainty to business planning, and so they may hold back a little bit on their capital investments until they wait and see approach. If there anything comes to fruition there, so that might keep a top on some of the returns. But when there's one loser in the tariffs, there might be another winner. If China does have a lot of tariffs, maybe it's going to be South Korea or Japan that benefits. Some other country is going to step in and fill up the supply. Inflation, we expect that to remain relatively low, 2%, 2 or 3% area, as it has historically been. U.S. economic growth, our baseline scenarios, yes, it's maybe not a recession, which would be indicated by negative growth, but we might go from let's say 2.5% growth to between more 1% or 2% growth, which again makes us want to look elsewhere for returns across the globe. So as usual, we want to prioritize our diversification amidst some of this uncertainty of what's going to be happening next in the global economy and the world. So, Kevin, not too many questions pouring through right now, but we do have one. Kevin, you mentioned the potential lowering rates for 2019. This is we stay away from politics here at Tobias Financial Advisors, but in the next year, do you think there'll be even more pressure on the Fed to act going into an election year?
Yeah, always a good thing not to go down the politics rabbit hole, right? No, I think the Fed has made themselves crystal clear that they've been responding. If there was any pressure on the Fed, it came from the markets, not from the Trump administration. The markets kind of boxed the Fed into a corner, into where they are at this point in time. Back to what I said before, then if they are going to only cut rates one more time, they have to message that to the markets. And that's going to be an important development, I think, going forward, if in fact that comes to fruition. So no, I don't look for politics to ramp up pressure on the Fed. Could politics ramp up the tweets or comments from the president? Absolutely. That I wouldn't rule out. But we've seen that already. But I'm fairly confident that the Fed is going to respond more to incoming data and be data dependent, and they will certainly try to manage their independence accordingly.
Let's hope so. I appreciate that. Any other final comments from you, Kevin, before we sign off today?
Yeah, just real quick. One thing on the fixed income side, something that's been really resonating when we were out talking on the road, is utilizing a barbell strategy as sort of a core fixed income part of your portfolio, using either end of the barbell, one being our yield enhanced strategies, and on the other side, the U.S. Treasury floating rate note strategy. That would be, I think, something definitely investors and advisors should consider in this environment of uncertainty, and the fact that what we're dealing with is a rate outlook that is subject to uncertainty. So when you're doing a barbell, you're really not making a definitive call. And I think it's a nice, sound, time-tested, solid strategy for fixed income.
Okay, thank you. And if anyone wants to dive into the strategy or anything that you're hearing here today on our presentation today in regards to your own portfolio or just the global economy together, Kevin is always accessible through your advisor here at Tobias Financial Advisors for follow-up questions. And of course, we're always happy to engage and make sure that we are addressing your concerns, or just more if you'd like to learn more about any particular topic. So we thank everybody for joining us today, and thank you, Kevin, for making some time for us this morning.
Thank you. It's been a pleasure. Have a good one, everybody.
All right. Thanks, everybody. Take care.